Good afternoon, and thanks for attending. I am Phil Flakes, co-founder at Succession Link, and will be the moderator for today's webinar titled How to Win the Deal, Financing Your Acquisition in a Competitive Market. And so as of October 2016, Succession Link is now over 14,000 registered users. And so I would like to thank all of you in attendance for being a part of our growing community. For anyone brand new to the Succession Link community, we are the leading networking and communication platform for financial advisors looking to buy, sell, merge, and find succession options for their financial advisory practices. And so as a platform, we look to provide resources, data, and educational content. And today's webinar is a great example of the type of educational content that we like to bring to the entire community. So before we get started, there are a few quick housekeeping items to mention. First, this webinar will be recorded and it will be distributed by email to all attendees. It will also be available on demand through the Succession Link YouTube page, and there you can find all past webinars and podcasts once you become a subscriber to that YouTube page. And second, as always, we certainly appreciate anyone who asked questions during the registration process and on the registration form. And we will look to address as many of those as we possibly can throughout the course of the presentation. But if your question does go unanswered in this presentation, we will make sure to get that question over to today's presenter, and he will follow up with an answer either by email or with a phone call. And so in July of 2016, we announced a new strategic partnership with Live Oak Bank for them to become the lending partner to the Succession Link platform. And Live Oak Bank is one of the top originators of small business loans with one of the strongest loan portfolios in the country. The investment advisory lending team has built a loan portfolio of over $350 million in loans. And also in July, we had our first webinar with Live Oak Bank. And based on the overwhelmingly positive response and questions and just interest from that webinar, we're excited to have Mike McGinley back to present on financing. And this time around, more specifically, he'll be presenting on how financing can help you win the deal in such a competitive acquisition environment. And so by way of background, Mike McGinley is a senior loan officer on the investment advisory lending team at Live Oak Bank. And Mike has worked his entire career as a commercial lender, specializing in SBA lending. And so prior to Live Oak Bank, Mike worked at PNC Bank in Philadelphia, Pennsylvania, as an SBA loan officer and manager of the closing team. As a senior loan officer at Live Oak Bank, Mike originates new loans for the investment advisory team. And with that, Mike, I appreciate you taking the time to join us here again, and welcome.
Thanks for the introduction, Phil. I appreciate the opportunity to discuss with your audience how buyers can best position themselves to purchase an advisory business. We get numerous calls a day from advisors who would like to grow their business through acquisition but need guidance on how to position themselves to creditors and, more importantly, to sellers. There are multiple buyers for every seller right now, and depending on which study you read, you could be competing with more than a few other suitors to win a deal. Today, I'd like to discuss how to prepare your business, how to approach sellers, how to value and structure a transaction, how to finance a transaction, and lastly, how to execute a seamless transition. By way of background, Live Oak Bank was founded in 2007 with one goal, and that's to provide independent business people in niche industries. So unlike your traditional bank, we do commercial lending. We don't have brick and mortar. We're technology driven. We are FDIC insured, and we do have a national footprint. We have 390 employees based in Wilmington, North Carolina. And again, we focus on niche industries. So the team that I work on and my colleagues focus entirely on the advisory space. And then we also have teams who lend to other industries as well, such as healthcare, independent pharmacies, funeral home directors, just to name a few. Because we have that industry expertise, we're able to Really focus on the industry. We have folks and consultants from the industry and have backgrounds in the advisory space who help lend the money to the advisory space. So there really is a true focus on cash flow lending and advisory space opportunities. As of October 16, the total portfolio of the bank is about $3.5 billion. And again, we do this through speed, ease, certainty, and insights that's enabled by our technology platform. The advisory lending team started in 2013. We did our first loan in January of 13, and since then we've done almost $400 million in loans to the advisory space. The way that's broken up is we typically do about 65% to 70% acquisitions, whether that be an external acquisition or an internal succession plan. We also lend about 10% for working capital, 9% for refinance, 7% for commercial real estate, and 8% to what we consider recruiting loans or breakaways from one firm to an independent firm. Financing is strategic to the advisory industry for a number of reasons. We can help execute your succession plan. This allows the seller to monetize more upfront and have a liquidity event. It also gives buyers access to capital who wouldn't normally have that. You may have a junior partner looking to buy in, and they don't have the ability to make that upfront payment to a selling advisor, so we help with that. We also fund growth, which can lead to an increased valuation, whether that be organic growth through working capital. You may want to hire a marketing team, a salesperson, build a back office, or start a new location, so we can help with that. In terms of inorganic growth, we help folks grow through acquisition. And really, it is a competitive advantage for M&A. Right now you hear 5 buyers for every seller. It's actually a lot more than that starting off, and there's really probably about 5 buyers who are true buyers for every seller. And depending on the study that you're reading, it could be a number of different numbers there. But having the ability to finance that transaction really does help you win the deal. We'll go into structuring later on in the presentation, but if you're able to make that upfront cash payment to a seller, it'll put you on top of the stack, and you're also able to make a larger down payment, which allows the seller to monetize more. So it does put you in a better position to win the deal. So what we'll cover in this presentation is really a 5-step approach to acquisitions and preparing your business for acquisitions. The first step is to prepare your own firm. You want to make sure that you have a profitable firm on its own and that you are bankable on its own. You want to make sure that you have the correct staffing in place. One thing that we look at when we're analyzing an acquisition is to make sure that the back door is going to be closed when you're looking at making an acquisition. If you're trying to grow assets by acquiring another business, but your clients can't get a hold of you because you're focused solely on the acquisition, that's going to be an issue for your business going forward. So you want to make sure that you have the right staffing in place, you have the capacity to take on that acquisition, and that you're running a profitable firm. Next is the approach. You want to be the post-transition planner. You want to put your application, so to speak, to that seller to the top of the stack. And the way to do that is not only to show them that you have the ability to buy that business and that you're going to negotiate the right price, but you also want to make sure that you're demonstrating excellent client service, that you're focused on the things that a seller is going to look for when they're selling their business. They're not just focused on the valuation and the purchase price. They're going to be focused on things like what's going to happen to their employees and what's going to happen to their clients. Next is valuation and structure. Are you valuating the business properly? The price, which is going to be a function of the terms of the transaction, is oftentimes different than the valuation. So you want to make sure that you're coming up with a purchase price that makes sense. You want to make sure that you're structuring the deal properly. When we're working on a transaction, our goal is to make sure that everybody's interests are aligned, and you want to make sure that the seller is going to be engaged during a transition to ensure that those clients are moving over and they're going to stay there. Next is financing. If you are going to provide a down payment to the seller, you want to make sure that you can afford it and that you have good terms for that loan. So we'll talk about how we look at loans and how you can prepare your business to get that financing. And then last is the transition. Make sure that you're planning ahead of time, that you're both on the same page in terms of buyer and seller on how long the seller is going to be engaged in the business, making sure that the staff is in place from both firms to be able to help with that transition, and making sure that the staff have post-transition roles that are thought of ahead of time. In terms of staffing, this is a slide that comes from the Investment News 2014 Financial Performance Study, and it illustrates the amount of revenue per staff for ensembles, enterprise ensembles, and super ensembles. As you can see, super ensembles are firms with $10 million or more in revenue, and they average about $338,000 of revenue for or per employee. Enterprise ensembles, which have $5 to $10 million in revenue, average about $272,000 per employee. And all other ensembles, which are firms less than $5 million in revenue, average about $192,000 per employee. Also of note is that top performing ensembles have $285,000 in revenue per staff member. So really what we're trying to illustrate here is that you have to be thinking about how your firm is run and the profit and loss statement that you currently have year to year with your firm. If it's not profitable, then oftentimes it's going to be difficult to get a loan for an acquisition because you're relying entirely on the cash flow of the business that you're purchasing. So steps to creating a sustainable firm. You want to make sure that you're thinking about your profit and loss statement and how much you have in net income at the end of every year. Many advisors have thought of their practice in terms of simply revenue, expenses, and what you take home at the end of the year, which is fine. But as you start to grow and as you start to look at acquiring a business, it's time to start documenting a basic profit and loss statement if you haven't already. A basic P&L will help you determine how much net monthly cash flow is available to support acquisition financing. And it also allows you to start investing back into the business. If you have a net profit that you're able to invest as opposed to flowing directly to the owners, it's going to be an attractable asset when you're looking to sell your business, but also will put you in a better position to buy. A basic P&L will include revenue to the firm. In terms of a broker-dealer representative, it'll be post-grid. And in terms of an RIA, what you're collecting from your clients on a monthly basis. Direct expense, which we have here on average as being 40%, is really the cost of revenue-generating employees and owners. So that's going to be, your advisors, your rainmakers, and so forth. Overhead is going to be, what it costs to keep the lights on. Administrative compensation, rent, equipment, all the expenses that you incur to keep the firm running. And then obviously what's left at the end of the day is your operating profit. This is going to vary depending on, one, how much you may pay yourself in salary during the year, and then also, just based on how many expenses that you have, you're going to have a different operating profit. What we like to see is typically around 25% on average. But if there are more expenses and you have a lower operating profit, that's not necessarily a bad thing, especially if you have expenses that are helping you grow or improve your business. So in terms of preparing for an acquisition, are you ready to acquire? We want to look at your current business profitability and make sure that that can contribute to the debt service of the loan. So, we're really going to be looking at whether or not you're creditworthy on your own. And the way we do this is through a debt service coverage ratio. We're cash flow lenders. We're not looking at collateral necessarily in terms of being able to approve a loan. We're going to be looking at whether or not you have the cash flow and ability to repay that loan. So this slide discusses really how you can look at your firm's ability to make payments on a loan. So I'm going to go line by line and just explain what these formulas mean. The first is EBOC, or earnings before owner's compensation. You're going to look at the combined revenue of both businesses. If you're not looking at an acquisition currently, you can look at your revenue. If you are looking at an acquisition, and when we're analyzing a transaction, we're going to look at both businesses combined on a pro forma basis. So you take the revenue and subtract your operating expenses. That's going to equal your earnings before owner's compensation. You then take the EBOC number and you subtract out owner's compensation. When we do this, we're going to analyze personal tax returns and a credit report to come up with what we think is an owner's needed salary, not necessarily what they currently pay themselves. So don't think about this in terms of what you're paying yourself currently. Think about what you would need in order to meet your monthly obligations. And what's left is your net operating income. If you take your net operating income and divide that by 1.75, 1.75 is our cash flow coverage ratio that we look for, which essentially means we're looking for $1.75 of annual cash flow for every dollar of annual debt service to Live Oak Bank if you're getting a loan from us, and a seller note. And once you divide that by 1.75, that's the maximum annual debt payments the business can afford. If you take your annual debt payments and divide that by 12, now you have the maximum monthly payments the business can afford. To break this down into a simple formula, if you're looking at how much your business can afford, if you have $1 million in debt, you'll have $135,000 in debt service per year. That's a 10-year term loan at a rate of about prime plus 2.25 on average. And if you're looking at a 1.75 cash flow coverage ratio like we do, you're going to be required to have $235,000 in business cash flow after you've paid yourself as an owner to meet a $1 million loan. Now, if we're looking at an acquisition, you're obviously going to be looking at your business and the one that you're purchasing to come up with that number. So we've talked about how to prepare your business and how to kind of reflect on what your firm's financials look like in order to be able to make that acquisition. Now we're going to look at the approach. So you want to look at the profile firm that you're going to be purchasing. Look at the geographical footprint. Make sure that you're thinking about where you want to purchase that business ahead of time. It may be in the same geography as your current business, or you may be looking to expand to a new market. Look at the size of the targeted firm and make sure that it makes sense. We do have advisors who buy businesses that are larger than theirs, but it isn't the norm. Typically, the business that you're going to be purchasing will be the same size or smaller than your current firm. That allows you to take advantage of your own profitability to contribute to the debt service, but it also just makes sense. You don't want to bite off more than you can chew. Look at the business model. Make sure that you're looking at businesses and putting bids on businesses that fit into your firm both culturally and in terms of processes, you're using the same type of processes. And then end client profile. Make sure you're thinking about things like the average age of the clients of the business that you're purchasing. making sure that there aren't any large client concentrations that can pose a risk when you're transitioning that business, and then also trying to hold on to those clients. And then making sure that the number of households per revenue is similar to what you're doing, or if you're trying to improve your ratio, you're looking for businesses that will help you improve it. How to be competitive. These are things that you should be thinking about ahead of time. What's your timeline? When are you trying to make the acquisition? Be the post-transition planner. Develop goals. When you're approaching a seller and you want to talk to them about how that transition is going to play out, how long the transition is going to occur, what the timeline of the transaction should be. If you develop goals with that seller and hold them accountable, it's going to be a much better transition. And preparing for that ahead of time is a good reflection of you and how you're going to work during that transition. Don't shy away from the emotional side. We did a webinar a couple of years back with 250 selling advisors, and during that webinar, we asked them a number of questions live. And the number one thing that came up in terms of what sellers are focused on during their transition, number one was far and away what happens to their clients. Number two was what happens to their employees. It wasn't until number three where they started talking about getting the right price for their business. So as a buyer, if you're solely focused on price and you're not thinking about really the goals of the seller, then it's going to be tough to win that transaction. Demonstrate good client service, great client service. If you're approaching a seller and you can demonstrate to them that you serve your clients in a way that they like to serve theirs, they're going to feel much more comfortable with you as the buyer of their business. Meet clients and staff whenever possible. This isn't always a possibility, but if you can meet the clients ahead of time, especially high net worth clients, and they're comfortable with you as a buyer, that's going to make the transition much better, and it's going to make the seller much more comfortable with you as the buyer. And then also coming with a bank relationship. Having the ability to finance that transaction and proving to the seller with a proposal letter from the bank that you can give them the down payment that they're looking for, and you have that proposal letter from a banking institution, you should go to the top of the stack. They're going to be much more likely to work with you. So now that we've talked about the approach, I want to talk a little bit about valuation and structure. So the main drivers of economic value are cash flow, growth, and risk, especially if you're looking at a discounted cash flow analysis. Some of the risks that we look at and that you should be looking at too are fee-based versus transaction-based. Fee-based books are going to get a larger multiple. Client concentrations, the average age of the client. You want to make sure that you're not purchasing a business that is falling in value based on the average age of the client. If they're decumulating assets as opposed to accumulating assets, then obviously that's going to be a business that's going to fall in value if it's in a steady state. Number of households, average revenue per client. You want to look at the processes, the team, and the culture to make sure it'll be a good fit. And really what we consider to be a fourth driver of economic value is transferability. If I'm a buyer and the selling business has clients who only know one individual, so it might be a solo practice, or it's a firm where the selling advisor is really the only person with a relationship with those clients, that's going to be a little more risky in terms of a transition because now that one person that they know is gone. It doesn't mean that there aren't clean transitions with solar practitioners, but if you are looking to sell your business, having a succession plan and bringing in junior advisors or a team that know those clients does help a little bit. So price versus valuation. There is a difference between price and valuation. We just talked about the drivers of economic value, and oftentimes valuations are a combination of revenue multiples, cash flow multiples, and then for larger firms, the discounted cash flow analysis. But oftentimes, the price is not going to be the same as the valuation. In fact, almost always it's a different number. The price is really going to be a function of the deal structure. So, deals that are going to be paid over 10 years are typically going to be a lower price than a transaction where you're going to pay everything up front. So, really, the terms of the loan and the transaction are going to affect the deal, and that's going to be based on who's taking on more risk, buyer or seller. So in terms of structuring transactions, the traditional structure has always been that you get 20 or 30% down as a seller, and typically there's an earnout attached to the rest of the purchase price, and it's paid over 3 to 5 years. That was really prior to bank financing because a lot of times buyers didn't have the ability to make that down payment. In this sort of transaction, seller has ongoing involvement and ongoing risk because they're holding a note for a large portion of that purchase price. With bank financing available, typically sellers monetize more upfront, so sellers are happy. The buyer gets a 10-year term loan with our note, so they stretch that out over a longer period of time. And oftentimes, if you're giving the seller more upfront, they may discount that purchase price a little bit for you because they're monetizing more today versus later. And time value of money would tell you that there should be a discount there. As a bank will typically finance up to 75% of the purchase price in the form of a down payment. And if you're financing 75%, then there would be a 25% seller note that's typically paid over 3 to 5 years. The average structure that we see is more like a 50-50 split. And if you look at the example we have here, there was $1 million purchase price. Half of it came from Live Oak Bank in the form of a down payment at 10 years at prime plus 2.25, and the seller note in this example was over 5 years at 6%. That's pretty much the average structure that we see, and typically there is a clawback provision or revaluation on the seller note so that the buyer is protected from any assets that don't move over. In terms of getting financing for a transaction, we look at a number of different factors. The largest factor is cash flow, and simply, can the business pay us back? We also look at the individual owners of the firm. We look at their credit, and we look at their personal balance sheet. So we're often looking at a credit score of at least 680. Cash flow coverage ratio, which we went over before, of 1.75, and a proven track record and good standing in the industry. If you're looking at it in terms of the cash flow analysis, we look at the cash flow of the acquirer, we add in the pro forma cash flow of the target company, and that will equal the cash flow of the pro forma business. And then once we subtract out the individual owner's required salary, what's left is the ability to pay us back, and we're looking for again, a cash flow coverage ratio of 1.75. Quickly, I'll go over our loan solutions and terms. For acquisition transactions, it's typically going to be a 10-year term with no balloon payment and with no prepayment penalty. Average rate of prime plus 2.25. We do utilize the SBA program for a number of our transactions. We are a full commercial bank, and we offer conventional financing as well. But with the SBA product, you do get the advantage of a 10-year term and typically a lower rate. We'll provide up to 100% financing for a lot of the reasons why we lend: working capital, refinances. We typically don't lend 100% for acquisitions, and the reason for that is because we want the seller to hold a note for a portion of that purchase price so that they're engaged during the transition. So you talked about valuation, price, structure. The next thing that you want to talk about with a seller and you want to plan ahead of time is the transition. And the transition, you want to talk about how you're going to start integrating clients, but you also want to talk about how long the seller is going to be engaged and work during that transition. Some sellers want to be there for as much as 5 years, and a lot of times buyers may not want the seller to be around that long. They may want them to be there just for that transition. So, we recommend just putting that out on the table early on in the process. At Live Oak Bank, we typically like a transition of 12 months. And the reason for that is it really doesn't take longer than that typically to transition clients over if both buyer and seller are engaged. And a lot of times buyers do want to implement their own processes into the new entity once that transaction is done and the transition has occurred. So talk about how A clients, B clients, C clients, and so on are going to be contacted, and really building a timeline from the get-go is a good idea to talk about, really get into the details around how they're going to be contacted. Is it going to be a face-to-face meeting? Is it going to be over the phone? How many meetings are the seller and buyer going to have together with that client? What will the seller's role be going forward? And what will the seller's staff do during the transition? You really do want to involve the staff, especially if they have interaction with the clients. So talking about that ahead of time and laying that out on the table is a great idea. Also putting that plan into the purchase agreement is important so that both buyer and seller see it, it's in writing, and it's agreed upon. Some of the potential deal killers that we see is really not engaging in the emotional side. We talked about this before. You really want to talk about what's going to happen to clients, employees, both before, during, and after the transition. We had a deal that fell apart at the 11th hour, and really was because the buyer and seller didn't lay this out on the table early on. So they're a week before closing. They're talking about what's going to actually occur on the date of closing, and the buyer said, we're going to look to get rid of employee so and so, and how should we contact them, and what's the best way to do that? And the seller said, wait a minute, you're going to let go of so and so, and they said, yeah. So because that was a deal breaker for the seller, deal fell apart right there. After months of preparation and going through every step of the process, it ultimately died just because of one thing that they didn't lay out early on. Make sure that you get experts involved when appropriate. There are great third parties out there to help you with valuations, structuring transactions, consulting with buyer and seller on how to properly structure that transaction, how to paper the transaction. Feel free to contact me if you need to know who to engage on the consultation side, and we'd be happy to set you up with that. And the other thing is different opinions and value. So I mentioned before that there are a number of different ways to value a business, and there are different opinions there. You can make up for differences in value by changing the terms of the transaction and shifting the risk between buyer and seller. So just know that if there is a difference in opinion, that is a hurdle that you can get over, and hiring a consultant to help you with that is a great idea. We're very consultative in nature as well. We're always happy to have those discussions early on. We do get involved early on in the transaction, but know that there are folks out there that can help you with that. Some best practices: create a comprehensive plan with milestones, get evaluation done early on in the process, manage your emotions. If you need to step back from a transaction for days or weeks because there's a difference between buyer and seller, that's okay. There are going to be differences in opinion, and just take a step back and manage those emotions. And again, hire professional support when needed. So just to wrap up, we've done a blog that is 5 things to nail a deal. And these are really things that we're seeing buyers and sellers do well. We talked about a lot of these things in the presentation, but I'll go through them just to kind of bring everything to a conclusion. Make sure that there's an understanding of the purchase price through evaluation. Make sure that financials are strong on both sides of the deal. That means buyer and seller. As a buyer, don't think that you can increase the profitability of your firm, or rather make your firm profitable to begin with, by going through an acquisition and adding scale. That will help you build profitability. It'll help you grow your business, but your financials really need to be strong going into a transaction, especially if you're going to look to get financing. Make sure the cultures are a good match. This is huge. We talked about not shying away from the emotional side. Create a roadmap for the new firm ahead of time. Involve the staff of both firms, and again, whenever it's possible, especially high net worth clients, if you can meet them ahead of time, that's going to be great for the outcome of the transition. And then again, talk about that seller transition ahead of time. Lay all the cards out on the table and make sure that you're on the same page. I appreciate everybody's time today. My contact information is on this slide. You can also get it through Succession Link. I'd like to again thank Succession Link for putting on this webinar, and for all of you in attendance. We have resources on our website at www.liveoakbank.com. There's also a link on this slide that brings you to our Knowledge Bank. Our Knowledge Bank allows you to take advantage of some literature that we have on our website, including white papers. We have the slides on here where I talked about cash flow coverage ratios and how we come up with our numbers. So you're more than welcome to go there and get those resources. And again, if you have any questions, feel free to call me or email me at mike.mcginley@liveoakbank.com. Thanks again, and look forward to speaking with all of you individually.
Mike, thanks for a great presentation and your partnership. One thing you mentioned that I would like to remind our audience about is how to get additional information about financing through Live Oak Bank. So if you are a registered user or a premier subscriber to Succession Link, once you're logged into your account, you'll see an advertising banner on the right-hand side of your screen in the dashboard section. If you click that ad, it will bring you to a form that pre-populates with your information that we have on file, and you will want to complete any info that may have changed or that is not populated and simply submit the form. From there, a member of the Live Oak team will reach out to you shortly. Another convenient feature and way to access the form is if you have used the deal terms calculator on the Succession Link site to calculate the value of any practice that you find in the marketplace, you will see a red Get Financing button that appears. If you click that button, it will pull the details from the practice in question, and again, you will want to update and complete the form and click Submit. Or as always, you can feel free to reach out to our customer support team at info@successionlink.com, and they can certainly point you in the right direction. So thanks again, Mike, and thanks to everyone in attendance. We certainly appreciate your continued support of the Succession Link community. Have a great day.